oil prices here holding on to gains as Israel vows a painful response to Iran's missile attack. And joining us now is the Shork Group principal, Stephen Shork. Stephen, it is great to see you. So, oil is extending these gains, Stephen, but maybe not as much, actually, as some might have thought, given what we're seeing in the Middle East and what could be coming. I'm wondering, what are the reasons for that you see?
This has been the general theme for the past year when essentially the war in the Middle East broke out last October 7th. And that is to say that the market traders are supremely discounting the potential of a prolonged disruption to the flow of oil around the world. So I'll give you a for instance. So last October, in the midst of the tragedy that began on October 7th, volatility in both the Brent crude oil market and the NYMEX WTI market was trading, I'm just looking at my numbers here, at about 38% implied volatility. So what does this mean? This means that on any given day, the typical price return on either contract was about $2 a barrel. Now, from October through the lull of the summer, that volatility was halved to about 20%. So that price return, daily typical return, dropped to around $1.10 to $1.20. So clearly, this was a risk premium that was never priced into the market. What we've seen since August now is volatility, implied volatility, and this is the market's estimate of future volatility, has slowly ticked higher to now, whereas a typical daily price return is about $1.50. So that led up to the events that we saw this past week. So what we've seen over the past 2 months is volatility or risk premium slowly being priced in. But once again, the general theme here is traders just do not think they're putting a maximum of minimum concern that we'll see a prolonged disruption. And quite frankly, I am perplexed, but this is the market that we have to trade in.
So, in other words, you're perplexed because you do think there is a higher likelihood than is being priced into the market of a more major and prolonged disruption of supply from the Mideast?
Oh, absolutely. We've already seen a major disruption to the flow of waterborne crude oil, that is, crude oil put on tankers in the Middle East, having to avoid the Red Sea, having to make longer journeys with fewer backhauls. So the expense of chartering, insuring, and moving a vessel of oil over the past year has rallied tremendously. And yet that rally, the cost to move oil has not really transferred over into the price. So I think the market is clearly underestimating a potential. And therein lies the concern here that if the market hasn't priced in a risk premium, and again, admittedly, implied volatility has increased over the past 2 months. So this is a telltale that some risk premium is being priced in. But relative to where we were a year ago, the market has not priced in nearly enough risk. And God help us if we do see an escalation of the war in the Middle East, and we know we are going to. The question is, does now Israel go after Iran's oil and gas infrastructure, which has been hinted in the market? If we see a disruption of that, and then, of course, what is Iran going to do? They're going to lash out, not back at Israel, but they're going to go after Saudi and the other Arab Arab producers, Iranians and Persians, of course. So they're going to go after the other infrastructure. So we are really playing a dangerous game here, where we are really at risk of a major disruption to the price of to the movement of oil, and the market has not priced in this risk.
Let me ask you, Steve. Let's say Israel did target Iranian oil facilities. Help us quantify that. I mean, how many barrels could that knock offline? And also, do you think if that happened, I'm curious, do you think the Saudis might step in and try to fill that gap at that point?
Well, certainly would. And I'm talking keep in mind, allegedly we have an embargo, or there's an embargo on Iranian oil, but we're still talking about a few million barrels of Iranian oil that's making it to the market every single day because they are flouting the tariffs and countries because they can buy Iranian oil at a discount because of these embargoes. Certainly have a demand there. But if we knock out of that, is to say, if Israel knocks out that ability, we're taking 3 million barrels potentially of Iranian oil off of the market. Now, there is about a 5 million barrel margin that OPEC could fill, and i.e. that would be Saudi Arabia. So clearly Saudi Arabia would stand to benefit this. But let's keep in mind, the Iranians Shia Persians do not really like Arabs, Sunni Saudis. So if they see a move by Israel to take out their assets, Iran's going to respond not to it. Well, they'll respond to Israel, obviously in a military sense, but they'll go after Saudi Arabia economically. And this is really the game we are playing right now. It's an extremely dangerous game that, yes, Saudi Arabia can fill the void. Bottom line is, it's very unlikely Iran is going to allow them to fill that void.
Stephen, great to have you on the show. Thanks for joining us.
Thank you.